Warm welcome, everybody, to this session on being investment ready, how to build a business, investors trust and buyers value. So let's get ready for some knowledge bombs here. I'm Adam Kudryl. I'm Director of Legal Strategy and Operations at Harper James. I'm joined by Mark Freer. I'll introduce himself in a minute. An investor with over 25 years investment experience in private equity and growth capital markets. And we've both got a lot of experience securing investment deals that protect founders' interests and maximize value, having between us supported literally hundreds of entrepreneurs through the process. Mark's got a unique perspective, which I'm really dying to share with you, having worked with a range of owners and management teams, and he'll tell you a bit about himself in a moment. Today, you're going to learn about how to emotionally and organisationally prepare for a funding round or exit, develop strong teams, engage the right experts around you, and when to do that, choose the right investors, and align exit strategies. We'll cover investor priorities, practical steps for readiness, common red flags, and how to boost confidence through strategy and governance. So let's get cracking. Mark, tell us a few things about yourself.
Well, thanks, Adam, and thanks for inviting me today. I think the first thing I wanted to say was that spending 25 years in the private equity and growth capital markets was probably a journey of highs and lows. It wasn't quite what I expected.
Okay.
I suppose a little bit naively, I expected a world of spreadsheets and numbers, and what I got was a pretty sobering experience in human psychology.
Okay, that's interesting. That's interesting
because it's investing is more of an art than a science. And it's all about the people, trying to assess the people, what makes them tick, assessing their capabilities, and really trying to find out how to work with each other over sometimes a short period of time or sometimes a longer period of time. I also found it a very humbling experience. I think it really is a real privilege to be invited into somebody's business, be taken into their confidence, and have a front row seat, if you like, into some of the inspiring things that go on in private companies across the country. Hear the human stories and play a small part, in their growth journey.
Great.
But now as a chair, I get to work with business owners in a different way. More as a sounding board, but still trying to help them navigate their challenges, but also opportunities, and particularly if they're looking to take institutional capital on board for the first time.
So that relationship with the investor is part of your kind of chairman role. Yeah,
absolutely. I mean, I think stakeholder management is absolutely fundamental when you are chair of a business, to make sure that you are mindful of all the differing needs of the different stakeholders in the business, one of which is the investor. But as we all know, there are many stakeholders in businesses.
So just we're going to kick off with a quick live poll. So those that you want, participate through the button on the screen. We're just asking the question here: what's your next milestone for attracting institutional capital first round, scaling up, or exit? I'll give you a few moments just to think about that question. Look, in the meantime, we'll kick off with first topic, I think, Mark, really. So you've worked as an institutional investor. What's been the main themes that run through your experience working with business owners and founders?
Well, I mean, the key thing is obviously we're talking about are they ready for investment? And I think that's something that I've certainly seen being done well and being done less well over the years. And I think the first thing I'll say is that the coming together of business owners with institutional investors is not something I'd call a natural alliance. You've got two very different worlds colliding, really. A lot of owners that I've come across in the past, they can be pretty suspicious of institutional investors and what their involvement could mean for them and their business. They're not natural, bedfellows. If you remember, owners set up their own business for a reason. They want to be in control. They want to run things their own way. They want to be their own boss. And I've often found that the first pound of equity is often the hardest to part with. Because it requires the owner to really sort of face up to the fact that their change is coming. And for many that is quite difficult. It's a change in mindset, often a leap of faith, a step into the unknown, and many owners can't do it. They can't emotionally get their heads around actually bringing the investor into their business. And I think this is often overlooked, I think, by some people in terms of the owner's own emotional state of readiness to take an investor in the business for for the first time. It is not easy. It was something I was very mindful of when I was looking at investment opportunities. First and foremost, how would they feel about investor coming into their business for the first time? And so when I hear people talk about, are you business ready? I actually, as an investor, I'm one step before that, which is actually, are the people institutionally investment ready? Are they ready for the change that's coming? Are they ready for someone else to be in their business, to challenge them, ask questions, and really to embrace the corporate governance that is required by institutional investors? And so for me, it's a very much a mindset. It's that sort of, sitting there thinking, actually, how will this feel for me? And am I actually ready for it? And I think it's about having an honest discussion with yourself about actually, how will I feel about this?
Yeah, so you're talking dynamics and relationships, and then with your investor and thinking forward with your investor, it's with your team as well, I guess, isn't it, as well? It's also relationships, hugely important, psychology, the self-reflection elements. In practice, what does that look like then?
Well, I suppose there's a couple of things I would highlight, is that staying on the sort of the shareholder piece, obviously, there's many situations where the owner has 100% of the equity, but there are lots of businesses out there where they have a group of shareholders. And so for me, actually, again, even before you're starting to think about being investment ready or business ready, in terms of, have you got alignment in the current shareholder group? I remember a business many years ago I went to see, and I met a couple of the shareholders there, one of which was the chairman, actually, and we had a couple of hours together. It was a fascinating meeting, and at the end of the meeting, the chairman said to me, he said, "Look, Mark, could you come back in 2 or 3 weeks' time and actually facilitate a meeting of the wider shareholder group?"
Yeah.
I said, "Yeah, of course I can." And sort of fast forward a few weeks, and we talked. I suppose I sat in what I can only describe as a quite highly charged and emotional atmosphere, actually, where you had 7 or 8 shareholders, each taking their turn to talk about how they felt about their shareholding, their attitude to risk or appetite for risk, the pace of growth they were happy with, some murmurings about discontent about how the current equity was split and whether it was equitable. I mean, it was really eye-opening. I think I don't think they probably would have sat down in a group like that for years, and they certainly weren't institutionally ready. And, so I suppose it brought home to me that often when you are thinking of taking investment, that's almost the trigger or the catalyst to confront issues that probably have been, bubbling under the surface for many years, but you just haven't addressed them.
Yeah.
And so, having alignment amongst your group of shareholders is so important, because if you don't have that alignment, just bringing another investor into that mix is just going to compound the problem.
Yeah.
And you're just going to store up problems for later. So I think the first thing to say is make sure look at your current shareholder dynamic and make sure that you're aligned as a group, even before you start thinking about taking investment.
Yeah.
And then the second thing I would say is, be really clear about why you want to take the money.
Yeah.
There's a business I invested in probably 10, 12 years ago now, and this business was owned 100% by one individual, and actually he felt that his shareholding was holding the business back.
Right.
Because every decision he was taking felt like a heavy burden on him, almost as if all his wealth was tied up in the business, and so every decision he was making, it felt like he was putting it all on red every day, and so he felt, because of that, the business was quite risk averse.
Yeah.
And that wasn't right for him or for the business. So actually, taking investment in that situation was right for him.
Yeah.
And it was right for the business, because it was almost released the business to take on more risk.
Yeah.
And so I'd be really clear-eyed about, why you're taking the money. And if it's just about the money, or you're looking for an investor to appease you, then you're not going to attract the right sort of investor to your business. So I suppose in some of the three things I talk about, I'd say is, are you emotionally ready for what's coming? Is your shareholder group aligned? And is there a good reason for the money? It should really make a difference, and you should want, not in a reluctant way, you should want to embrace what bringing an investor on board will mean for you and your business.
Cool. So sometimes, quite often, the shareholder base is different to the management team. And we talked there about a lot of self-reflection and alignment on why you want to go on this journey, investment and say institutional money. Yeah. And what about the management team? What's the key attributes you look for there? Is it the same sort of self-reflective process? And
absolutely, I think if you are taking investment, I think it runs through the whole team in terms of thinking about, are you ready yourself for what's coming next? And I think, over the years, I think there's a cohort of business owners that think that just because their business is profitable, it means that they'll be able to attract investment. And that's not really the case. And because there is a world of difference between a good business and a good investment. There's lots of things, but normally lying at the heart of that is the quality of the team, and in particular, the leader. There's never going to be enough time to turn over every stone when you're looking at an investment opportunity. And so your assessment of the team is absolutely fundamental, to your investment assessment. And I've often found that the business reflects the character of the leader. They set the tone. If their thinking is sloppy, the business will be sloppy. If they are reckless, the business will take unnecessary risks. If they're disorganized, the business will be disorganized. And importantly, if they have a poor attitude to corporate governance, then that will run through the business. And the right leader will hire the right people. They'll build the right team, but most importantly, they'll set the right emotional culture in the business to make sure things are done in the right way, and issues, will surface. It is so important. And so for me, the character of the leader was a non-negotiable. There was many opportunities I turned down because I didn't feel like that person was investable. And to your point, Adam, I think one thing I would say to owners or CEOs, etc., the leader, I'm saying is, I think if you're looking to take on investment, I think you do need to take a hard look at yourself in the mirror, and think, actually, am I ready and able, to lead an institutionally backed business? Because it is different. There is a period of self-reflection and introspection, I think. But I was always looking, in terms of the attributes I was looking for in the leader, I was looking for that emotional maturity, that self-awareness, that open-mindedness to the fact that things will be different, and will they embrace the change that's coming? And that could be in a number of situations, like how do you feel about being challenged? Will you take it all personally? How will you feel about others being involved in the key decisions that you're taking? And then most importantly, will you put the company needs before your own? Because the issue that always arises in a lot of these situations is succession. And growth doesn't happen in a straight line, does it? And it's very hard, running a larger business than maybe what you're running today. So, leading a 10 million turnover business and leading a 30 million turnover business is very different skills. And is that recognised by the leader? That actually say, we need to put the company needs first here, and the other stakeholders' needs first here, to make sure that this business can thrive. And so, egos can get in the way. And so actually, is there that open-mindedness that says, we've got we're going to be doing the right thing for the business, and that might involve, shuffling the pack a little bit in terms of how the jobs that people are doing. And I've often found actually that a lot of CEOs, they don't actually like the job that the CEO role entails. A lot of owners set up business because they're creative. They're creative people. They don't like some of the mundane day-to-day stuff and some of the difficult, hard stuff that the CEO has to do. And so, sometimes you can just find the right solution that says, actually, the best outcome is you do more of that. And then in terms of growing the business, somebody else comes along to do all the stuff that you don't really want to do. So it's those sorts of things really that I always look for in a leader, is that is that emotional maturity to say, actually, things are likely to change if we're going to grow like this. And I think you always got to be thinking, am I still today the right person to lead this business?
Okay, cool. And that goes to the heart, I think, of forming the team around you, doesn't it?
Yes.
Because it's that self-reflection. I'm good at X, but I'm not good at Y, but I've got Dave come in, he's doing Y.
Yeah.
Jenny's doing Z. Sort of thing. Yeah. How we're talking about investment readiness and kind of private equity or institutional, how formed does the management team need to be?
I think it depends on what type of investment you're taking. And we'll come on to this, I'm sure, a bit later, but certainly I think in a private equity context, they do like to see a fully formed team because they're operating in such a short time frame.
Yeah.
I think in a situation where you're maybe not taking majority shareholder into businesses or minority situation, they tend to be more patient investors, and they're probably used to more gaps in the team that can be filled over time. But growing a business is a team effort.
Yeah.
I often think about it in terms of moving through the leagues. I mean, as you get promoted, the challenges are going to get tougher.
Yeah.
And the competition is going to be stronger.
Yeah.
So the question really is, is the team that I've got in place ready for what is going to happen next? And a lot of that is about, have I got the balance and the caliber of the team right? And are they ready to cope with maybe the demands that higher growth is going to place on them? And often you can find, particularly in, I suppose, smaller businesses where the capability of the owner can often is such that it can often compensate or mask other shortcomings in the rest of the team. They're doing 3 jobs, or whatever it might be. And often the drive and the ambition of the owner isn't matched by other members of the team. And you can often see that in the finance team. Particularly sometimes where finance is very structured, and very used to doing things in a certain way. If you suddenly, it's just turning the wick up on that in terms of now the demands on it, it can lead to resentment. And so that's one area I think you should always be looking for. And the thing I wish to get the CEOs that I backed to do was set out a proper people plan.
Yeah.
That says, look, this is the chart today. This is, and almost, and also talk through how you rated them really as well. Were they going to be able to complete the journey or not? These are the gaps. This is how the organisation chart probably should look like in 3 to 5 years' time.
Yeah.
So always thinking about the HR and the next stage that says, actually, I've always got a team that's match fit for what I'm trying to do. And this isn't just about ability, it's about capability. And if you're looking to scale a business, you have to think about that, because what you can't do is just have more dependency. At some point, the leader has to release a lot of the things and responsibilities that they're responsible for, and you've got to trust people, and you've got to develop that. You've got to develop that mindset into people that says we're going to be taking on more responsibility and authority, and can we deal with that?
Yeah. Okay, that's interesting.
Yeah.
That's interesting. We talk about forming the management team. Obviously, if you've got a team sheet of newbies, that's not an ideal scenario going into an investment round, is it? So,
well, I suppose I always like to see, particularly when I was I've worked in both markets. I've worked in the private equity market, and I've also worked in the growth capital market. And I think in the private equity market, I always want, because you're under such short time frames. Back when I was doing it, starting in the 1990s, it was very much a 3-year thing. I think timeframes have extended now a little bit for a number of reasons. But normally when I was in private equity, it was very very transactional. It was very much, you're in this for 3 years. Everybody knew what they were in for, and so you wanted that team, in the blocks ready to go. And they had a huge amount of experience of working together. And so in an ideal world, they would have worked together for 10 years. And the person running it, and you can see the financial accounts and everything, they can say, look, this is our performance under our stewardship. And that's what you were backing, really. It says actually, as long as it's more of the same, actually you've been doing it for the last don't know how many years. You've been doing it together. You know all your strengths and weaknesses together. And I'm just coming in to back you. And so, so I think if you're going into private equity, I think it's very helpful if you've already got a pretty, fully functioning team.
You alluded there actually to different styles of investment, and we kind of everybody thinks about private equity and institutional in that short 3, 4, 5 year cycle to exit or next investment.
Yes.
But are the options out there? Sort of backgrounds in patient capital, isn't it?
Yeah, absolutely. And I mean, there are a number of options, but I think in terms of today, I think in terms of the institutional market, you've got private equity and you've got growth capital, really. And actually, it's about choosing the right one for you. And so I think, again, this comes back to your objectives. That actually, what is it you're trying to achieve? I think first actually working out, what do we want to do over the next 5 to 10 years? And before you then start talking to investors, because you might just end up talking to the wrong people. And actually, if you get the wrong shareholder in your business, it's a devil to get rid of them. It's not easy to get rid of a shareholder.
Expectations.
It's just difficult. It's just difficult to buying out a shareholder. And you don't want to feel like you just done all that work and actually I've just got the wrong person in my business now. So in terms of the two out there, private equity, they tend to be buyers of businesses, really. There's lots of variations, but they tend to be buyers of businesses, and they'd like taking a majority stake, being in control, and then really accelerating the growth in the business over a relatively short time frame, and have a real focus on exit. And so you as an owner or shareholder group will have sold a significant stake in your business. So it's a very different. That's a scenario where you're probably not in control anymore. And so, but then there's the alternative, which is growth capital, which is they tend to be less buyers but more partners, really, investment partners. They're happy with minority stakes, and so the owner remains in control, and the owner or the current shareholder group will retain a majority of the shares, and then they can go on a journey at a pace of their own choosing. And so there are two very, very different scenarios. One, it's really quite transactional, and it's quite a quick turnaround. And I think people know what you're getting, and that's fine. And then there's another one where we don't want to sell our business at the moment, really. So if you want to stay and you want to go on a path of your own, a growth path of your own choosing, then there are other options out there which may be more appropriate for you.
We talked about the team within the business. Okay. Now let's think about the team that you have around the business. So let's think about advisors.
Yes.
What guys really need to think about in terms of having advisors around them for that stage of the journey that they're going to take through the investment.
Well, over the years, I've always, realised the importance of having good people around you. And this not people just with sort of technical flair, but have the right emotional intelligence. Helping you navigate sometimes some pretty tricky situations. And I have come across a lot of business owners over the years that feel that they can probably do the job without advisors. And I would caution against that, because it's quite a complex area. You may be an expert in whatever you're an expert in terms of running your business, but the world of corporate finance and investment it can be a very complex one. And I think to have the right people around you in those situations is very important. And that often I've seen that people get it wrong, and they pick the wrong people at the wrong time. They may go for more of a general practitioner than a specialist. Right. And I think you do need a specialist in these situations. And I think you need the people who have seen it and done it before. And so they're used to all the variants that may come up in terms of things that can happen on deals. So I would always be mindful of the fact that you want to be working with people that you get on with. It can be a long, arduous, emotional journey, set up your business or take on investment. You want to feel like you've got like-minded people around you. People who will, you trust them to tell you the truth, really. They've got no ego. Yeah. And, they'll have your back, basically. But you also want to make sure that, as I said, the right type of advisors around you. So from a legal perspective, I would caution against, say, for the sake of argument, asking your employment lawyer to act for you on selling your business, because they won't be. You need a proper corporate lawyer, because they'll be more familiar with the documentation that you see in this market, which is generally accepted practice. Yeah. What I've seen before, when people feel like they'll just, they don't want to spend too much money. Yeah. They'll this is probably the most important, thing going on in your professional life, actually selling your business. Yeah. So get the right people around you. And I think people try and sort of, do it for less money, and it just ends up creating sort of undue tension amongst all the parties, because people aren't understanding all the various documentation. People who are familiar with the documentation just put people's minds at rest.
I've obviously been on the end of that as a lawyer, a corporate lawyer, throughout my career, and I think sitting on the other side of an advisor that's not done it before is very challenging to think where I've acted for investors. The investor relationship with the management team, because the management team have their lawyer telling them how onerous these clauses are, etc. because they've never seen them before, and not understanding the kind of the level of expectation of documentation in the industry. So I think that causes tension then with between the investor and the management team unnecessarily. That's what I'm saying.
It does, and I think I used to make sure I didn't subcontract a lot of. I never subcontracted the relationship.
Yeah,
let's put it that way. Yeah. I was always very mindful that this could happen, and sometimes people are out there looking to score points, aren't they? And actually, I always used to have the relationship with the team that says, look, if there's anything worrying you, just ring me, and we'll talk you through, because there's always a solution. And the last thing you wanted to feel that they are, steering somewhere, and get worried about stuff. Well, actually, there's nothing to worry about, really. But actually, it's sometimes it's about setting the right context of various things. But there are things that will be in that documentation that they may not be familiar with. I mean, this might include things like consent. And so, there's various things that will go on in the business, and actually they'll be, but they won't be able to do them without the consent of the investor. But these are normally significant things, like you want to make an acquisition, or you want to buy an expensive piece of kit, or whatever it might be. And I never really, I never really sort of relied too much on the consents to some degree. What I mean by that is they were there and they had to be followed. But actually, what I was relying on was the relationship with the CEO that says, actually, I don't care if I need a consent from Mark for this or not. I want to ring it to see what it says.
Yeah.
Do you know what I mean? Yeah. Again, that goes to the core relationship. It says, actually, if you've got a true partnership, and sometimes you were the single largest shareholder of that business. You felt you were backing someone that says, you know what, even though I don't need Mark's consent on this, I want to talk to him about it.
I want his view.
Do you know what I mean? And so I think it's when you've got that sort of relationship, it just worked really, really well. And what used to annoy me when people that just ignore the consent, because they're there for a reason. They need to be followed. But it's about setting them at the right level. There's other things in there like legal provisions. Again, what do you do when somebody wants to leave? What happens to those shares? I'm sure most people will start from the premise that says, if I'm leaving, I want to keep all my shares.
Probably.
And continue to benefit from the growth of those shares. You can imagine other members of the team might not feel the same with that.
I'm working for you.
So actually, I always used to talk about that. It wasn't a company investor issue. It was a company issue. It was actually there's somebody who wants to lead. It may be for good reasons or bad reasons, whatever that might be. But you need a mechanism to be able to deal with that. And normally, a lot of the time, I found that actually the team was harder on those provisions than maybe the investor at times.
Okay.
Because to the point where you just said, which is hang on, we're the ones driving the growth now. Why should you benefit from that? And so there could actually become, again, very emotive discussions if handled badly.
Yeah, absolutely,
Yeah.
absolutely. Yeah, I think it's the benefit of the experience of having done it as gazillion times is something you definitely pass on as clients that benefit, and definitely smoothens that process. You kind of the lubrication of the discussions amongst the management team, really. But it's definitely a conversation to have early, isn't it? Because getting further down and dealing it with when somebody wants to leave and not having those rules of engagement kind of can rip the business apart.
Yeah. Again, I suppose the theme I'm trying to bring across really is it is all about your relationship with the team, and particularly the leader, and you are totally aligned. You're not just aligned on the way in, but you do everything you can to maintain that alignment throughout the period of investment.
Yeah.
And that means spending time with each other, communicating well with people, finding out about, sharing the challenges of your world, and hearing the challenges of their world. Because I think if you hear more about people's challenges, you become more empathetic, don't you?
Yeah.
Sometimes there's this sort of unknown element of, why does he want that?
Yeah.
But if you explain what you want it, it's, just half help. So I always thought there's a real challenge in terms of maintaining that alignment. And, my style was very much to really, get to know the team really well.
Yeah.
So they knew that actually if I was asking for something, they knew it was coming from the right place.
Yeah.
Yeah. I wouldn't have been bloody minded about it. It was something that was important to me.
Yeah.
But actually, if you've got the right relationship and you formed that over time, it doesn't half help, when you're having those different conversations. I mean, growing a business is hard enough as it is, without you not getting on.
Yeah.
So being invested and spending time with people was, I think, key to being a good investor in this space.
We had an interesting actually, and it's for you. How do you prepare founder teams emotionally for the scrutiny of their investor and the reporting expectations?
Well, I think first of all, it's surrounding yourself with the right people. So I mean, a lot of times the investors will want to see the board augmented, and particularly having the chair on there. And I think if you are working with someone who's seen it all before, I think they are in a very good place to help you emotionally prepare for all these things, and it's particularly in the fine costing, as I said before. Also, I would get them to speak to other people who've gone through the process and come out the other side. And how does it feel, really? Because it is different. You suddenly gone through a situation where you don't really have to satisfy anybody, any third parties. There may be some information you have to show your bank or whatever it might be. But it's pretty much, we can do what we like, really. Thank you very much in terms of reporting. It's our business. But I always say to people, think of it as if you were an investor coming into a business. What would you want to see? What would you want to feel? And you want to feel like you were not ignored, really. And your requests were taken seriously, really. So I think in terms of emotionally getting ready, I think it's to surround yourself with the right people and making sure you don't go earlier than you should. I think some people try to rush it. I've worked with business over the years where we've taken a couple of years to get everybody ready. And there may be a baby step you can take, that says we'll get a different type of investor in first, who may have certain requirements, but we're not going to go on some sort of, aggressive growth story. But actually, we'll go on a growth story of our own choosing, and sort of, you're just dipping your toe in the water with it, see how it feels before you then may take the bigger step that says, we'll go and take a majority private equity investor into our business.
Yeah. And the emotional scrutiny, I kind of want to drill into that a little bit. You mentioned earlier on about not taking things personally. So do you almost envisage your board meeting with your investor, and there are things that haven't panned out quite as you've hoped that are under your responsibility? Is it almost a case of taking this? You obviously take responsibility, but taking a step back from it rather than it being a kind of a chip away at your ego or your worth. It's actually, well, we tried that, it didn't work, take it on the chin and move on. Is that the kind of mentality that you have to have with yourself?
Well, I think you've got to have that that armor, if you like, that says, that says, I can deal with this in a certain way. Because I think most investors, it's not, it's not personal. They're just trying to get to an answer, really.
Yeah.
And I think, again, it comes back to having that emotional maturity, I think, and self-awareness of how do you deal with those situations. And for me, it's a case of, when I think about some of the teams that I've built, particularly in recent times, is that I very much follow a model that says actually you've got to start with the right foundation. There's trust. The foundation of any great team is trust.
Yeah.
Because that then enables you to move to the next stage, which is what I call conflict. Yeah. But good conflict. When people are all working together and there's no, hidden agendas or politics.
Yeah.
People know that when they're actively discussing something, it's coming from the right place.
Yeah.
So you can have that good conflict, which is required to get to a good answer.
Yeah.
And then once you've got that, you can then get commitment. Because how many meetings you've been in, Adam, where actually, there's a load of stuff that's been said, and you might walk out and said, I don't agree with any of that.
So you don't disagree in the meeting.
I always want to create that environment. Excuse me, that people can have those.
Yeah.
So but then you come out and there's right, we're committed to this.
Yeah.
And it's only when you've got that commitment then you can make people accountable.
Yeah.
And then obviously you have the results that follow that. So it really is getting that bedrock right that says, have I got the right structure in my team? Do we trust each other?
Yeah.
And it only takes one pattern, so sometimes you do have to look at the makeup of the team to get that trust right, that conflict, commitment and accountability.
Yeah.
And then people know it's not personal, it's coming from the right place.
Yeah. That's a kind of far preferable approach to kind of like not taking criticism well and being kind of like owning it on your heart, really, taking things personally or emotionally. And I think probably if you imagine, instead of the state you're talking about, you're in a fear state. Yeah. As Yoda said, fear is the path to the dark side, sort of thing. But I can't imagine the relationship sustaining well if people are in a position of fear every day of their work.
Well, I mean that you don't want that, do you? And I think this, and for me, the lead has a role here to make sure that that's not taking place.
Yeah.
Again, it's about creating the right environment that people don't feel like, but also making sure that I think this goes to the fact that having the right partner is more important than valuation.
Yeah.
I think a lot of people start with the valuation and how can I get my business. I'll just turn it on its head. It's about having the right partner.
Yeah.
Clearly, you want to get a decent valuation, and I get all that. But these things that we're talking about, it's about having the right people in the room.
Yeah.
Who I always say, you need people there who are more of a thermostat than a thermometer. They know when to dial it down. When there's too much heat going on in the room, you need that sort of that composure, that equanimity, that calmness that says that actually, we know everything's not going to go right. So I always try to work with the teams that I work with on the basis that says, there's only a few things that need to go well to make this a good investment. So let's focus on those. Let's prioritize. We'll have 3 or 4 priorities, and you know what? We're going to execute them in a world-class fashion. And we'll do that.
Cool.
And if we do that, we're fine. I think sometimes people just get overloaded because they've got too many priorities. You suddenly see this list of 25 things that they want to do, and I'm thinking, well, let's do 3 or 4 really well. And so I think it's a case of, I think the leader and other members have got a leading role to play in this to make sure that create an environment that people don't feel overwhelmed and things like that. But because if they do feel overwhelmed, then I think it's incumbent on us in a more senior role to say, we need to help you. That might need to bring some other people to support you, or you need to go into a different role. And
then there's a bit of self-reflection required.
I'm very mindful, and what I've seen over the years, I'm very mindful of people's mental health, and how how important it is to make sure that they're working in an environment that could work to their favour. Really, that says that we can deal with any issues they've got, should they arise.
That leads into another question we've had, which is, how can you manage pressure to scale quickly when institutional investors have aggressive timelines?
Well, I'd answer in the same way, really. So I think, again, it's about having the right people around you who've done it before. And I think it's a case of making sure you're prioritised. Pressure, sometimes pressure comes from doing too many things. And I think what you need to make sure is you're prioritising a small number of things and do them well.
Okay, cool. So that pressure around timelines, and spinning that slightly different way, I'm thinking about, you obviously have your business plan and you're aligned with your investor towards exit. And I think where pressure could come in is where things aren't panning out quite as were expected in the business plan versus the expected time. And kind of how can people work with the investor so that they can deal with the immediate problem and flex the timeline as needed? Is that what's key to
I think honestly, transparency. I think there's no point in just working to a set of numbers that people feel have no G. Because that is demotivating. It really is. And I think even though it might be difficult for the investor to say, you know what, this was the plan that we backed, but actually things have changed, and so we might need to revisit that. That has to be addressed. Because otherwise, there's no point just setting numbers for the sake of it that people feel that they can't hit. So I think, don't get me wrong, I think, are there things that you can be doing in the business that could get you back on track to achieve that? Clearly, if you can't, then I think there needs to be realism about what is a sensible, realistic set of assumptions we have and advise the numbers going forward. And it might mean that we can still get to what we originally thought just a couple of years later. And so this comes back to having the right investor. So have you got that flexibility in that investor that says, actually, I didn't want to do for 4 years, but if it's 6 years, that's fine. So it comes back again to making sure that you pick the right investor at the start.
And around that was probably you can only tell so much in the pitching process, but is how open the relationship's going to be, the dynamic of the people that you're dealing with, and probably the overall profile of the investor, because you might be dealing with Mandy, who is your investment director now. She might not have for your whole investment cycle, but then there's the whole think about who the investor is at the top line, which organisation you're working with and what their key attributes are, I guess. Would you, I think when you're business planning and pitching, maybe you have core elements that are important to your business. How important is it to align with an investor that believes in those things versus just chasing the exit?
You always want to feel that someone believes in you, don't you? And they've got your back. And I think, certainly when I was having those meetings with the management team, I spent a lot of time just wanting to see how they worked as a team and how they ran their business. I wouldn't come in with a due diligence checklist. I wanted to really understand their story, really, and their journey, really. People don't buy what you do. Buy what you do. And that's really what I was trying to get to, is really what was driving them, really. And I think actually there are investors out there who I think you probably can get a sense of that meeting, and probably they are the right sort for you. Just by the way the questions they're asking you. What I always wanted to hear from a team was, look, it's not easy. There's highs and lows. These are the decisions we took. some of this ones we got right, these ones we got wrong.
Yeah.
These are the lessons we learned.
Yeah.
No one's looking for perfection. It doesn't exist. And so for me, it was really having that sort of honest discussion, which I agree, it can be difficult sometimes, but it's a bit of a contrived atmosphere. So I would always say to people, look, make sure you reference the investors well. And talk to the portfolio companies that they've invested in and see what it's been like for them, and hear it warts and all.
If you're lucky enough to have a competitive process, a number of investors wanting to invest in your company, have them pitch to you.
Absolutely.
Yeah. Why not?
Why not? Yeah, absolutely right.
Yeah. Good other question from our viewers. What's the most common mistake you see founders make when raising institutional funds?
Well, again, I think it's probably something that we just talked about. Really, is they prioritise value over valuation over partner. And and I think because you can, if you have got a very, very strong business, you've got a lot of interest. It can get a bit of a frenzy, can't it? And you have advisors there who are remunerated on the basis of getting you a good price. But for me, it's about what's the optimal price, really. And the best price for all parties. I think too many people see these situations as a zero-sum game. And it's not about one winning and one losing. Really, it's trying to find something that works for all parties, because then you have to work together for the next 5 years. And if one party feels that they've been shortchanged, good luck with that relationship. And I've always to think that actually, 12 months in, and at that board meeting, the 12th board meeting, and no one's mentioned anything about the deal. You feel, hang, you know what, that probably was a fair deal. And you're not going to get everything you want. And I think sometimes if too many people try and treat it like a zero-sum game, it'll just backfire on you. So you want to feel like there's an alignment and there's a fairness to what's been agreed. And that's always what I try to do. Was yes, there's always parameters that you have to deal with, in terms of pricing, whatever it might be. But it's not all about that. It's all about getting the right partner, and particularly if you're going to take on a minority partner over a number of years. Your first event is not your major event. I can understand it when you might sell 80% of your business, and you think market value is quite important here. But actually, if you're only selling 30% of the business, that's not the main event, is it? It's the supporting act, isn't it? Really. And then actually, you're then bringing in the right partner who can help you grow that business and hopefully make it a much more, bigger pie going forward. And so, in recent years, that's actually a lot of people have taken that route because they always get 2 bites to the cherry. There's a lot of owners that I've come across who they've sold their business and then regretted it because they've almost their status and their purpose was wrapped up in the business. And they, say, what do I do now? But actually, if I sell a minority and then grow with an invested partner over the next few years, and that can manage my exits over time, you can see why that might be attractive for some people.
On my side, I think I see deals at a different stage to you, because you see a lot more after the deal's done, completed, than I do. But there's 2 things I see. One is at the outset, taking the first offer that lands on the table. And often that can be an approach from an investor. If it feels right, it can be right. There are other times where I think people should look around.
I would always recommend that you don't take the first offer that someone's come on, because, well, not least because it might just be a fishing expedition, number one, and actually, do they have the financial wherewithal to deliver on it? So I think sometimes it's quite useful to bring on an advisor earlier, because they can help manage those approaches to the business. You can say, well, actually, my so-and-so deal to them, so speak to them. And then actually there starts to be a bit of a number of these things, then it might sort of trigger the thought that says, we'll run a process. But I think if anybody's going to preempt anything, I think it's got to be pretty compelling. for them to do that.
Yeah.
And actually, until you tested the water, you don't know if it's compelling or not, do you?
Yeah.
You know, so I think there's lots of times where people, have probably started their business suboptimally.
Yeah.
Because they probably did take the first thing that was on offer.
Yeah.
And actually, again, getting the right people around you with the right couple of finance advisors and lawyers, they can give you some guidance about actually what to do next.
Yeah. I think the other thing I see is actually I was going to mention in relation to that question, but it ties up to a question we've just had in, which is how far in advance should you start preparing for a raise? And I was going to say the other thing I think a common mistake amongst founders is preparedness. Yeah, and the very much having your house in order. Yeah, because the last thing that you want to be doing is through the investors' due diligence, upturning issues and basically showing that you haven't got your own house, your ducks in a row, house in order. How many other things phrases can I draw in? Yeah, that you've got yourself ready in terms of knowing what the business is, knowing what the key drivers of the business are, having all your contracts in place, and almost having a data room ready as you go into the process.
Well, if you don't, you'll lose value.
Yeah.
Because they'll pick holes in everything. And I think so, we talked about getting almost like your shareholder house in order.
Yeah.
Which I think is the most important thing to start, even before you start thinking about anything else.
Yeah.
But then talk about getting your business house in order, if you like. And I think the earlier you can start, the better. 2 or 3 years before you can start. It's just good practice probably to start, filing things away in a certain place.
Yeah.
Call it a data room.
Yeah.
And so you just know where everything is. And actually, just by doing that, you can almost do a bit of a spring clean. Actually, that says actually we'll just look at all our customer contracts, supply contracts. Are we complying with all applicable laws, regulations? These sorts of questions where, as an owner, you'll have to give warranties on. And so why not? Work with your legal. So your lawyer, and actually just run a little checklist that says these sort of things that we probably should be going to data room. Let's start digging those out, and making sure they're complete and appropriate and suitable. Because you might find that there might be various change of control clauses in lots of the customer contracts you have, and you don't want that them all coming to coming at the same time. And so it's very important to address all those things.
We've got, would you believe it, I was gone already, pretty much. But before we wrap up, from Mark, what's the one thing that you wish every founder knew before facing, it's a difficult one, facing institutional investors?
I suppose that that investors are not looking for perfection. They're looking for honest, credible, people who are realistic about their opportunities and the challenges that they face. I said before, I was always drawn to people who have that sort of sense of humility, if you like. That says, look, we don't know it all. Part of the reason why we come to talk to you, do you think you can help us? These are things that we've done. They've gone well. These things that have gone less well, and these are lessons that we've learned. I think I'd like to think that all investors know that it's hard running a business. There's lots of challenges every day, every day of the week. I think business owners, they deserve our admiration. It's difficult being in the arena. They deserve our support. So I would just say, find an investor that gets you, align your interest with them, and just go for it.
Cool. Thank you so much. Thanks for those great questions. And really, that concludes the Q&A in today's session. We've covered a lot, but I feel like we've only really just scratched the surface, and it has been an hour. It feels like a short time. So we will follow up with some more guidance and some more content. If you're looking for support for a fundraising process, the legals, the term sheets, please do reach out to us. This is part of a ongoing series of webinars we have. We've got loads on our website. You can see in our user insights section. Next Wednesday, 4th of December, we've got a new webinar release on data protection and commercial law about protecting your business from outages and breaches and how to respond quickly. We're launching our spring webinar session soon. So just want to say thanks everybody for watching. It's been fantastic. Thank you, Mark, for coming in. Look, really enjoyed it. We'll send you guys a short survey to see what you thought. Thanks again, guys, and all the best.